All right, I think we can start. So, thanks everyone for joining in on a weekend. Welcome to the sixth episode of Gifted Insights. I am Ankur, the co founder and CEO of Belong, and your host for today. Um, Belong is an savings and investment app solely for NRIs, and we make it easy for you to invest in Indian and global markets. For today's topic, we are going to discuss something which is very topical given the recent slide of rupee against the dollar. So we are going to discuss, what are the trends that we foresee, and how should one, structure their portfolio in terms of their India and global investments. In order to discuss that, I'm excited to have Prateek Chaturvedi here. He is an expert in global market investments with over 13 years of experience. Currently, is the head of global investments at Neo Wealth, managing more than $1 billion in AUM. So, welcome, Prateek.
Thanks, Ankur. Pleasure to be here.
Awesome. So, just to set the context, uh, and yeah, everyone feel free to drop in questions in the chat while we are discussing this. We'll be taking them, as we go or at the end. Overall, Prateek, this topic for today is of quite interesting and relevant as we kick off the year, as
Yeah,
well as with the new administration in the US that has come in.
yeah,
So to begin with, just help us understand, where do you see the, global economic growth in 2025? What are the major pockets of growth geographically, and what are some of the trends to watch out for?
sure, sure. Happy to do that. So I want to break down this answer into geographical, different geographies and answer those separately. So it's primarily talk about the largest economy in the world, that is US, right? Kunal, if you can go back to the previous slide, that's fine. So, see, the thing with US at this point of time, and I just want to talk some data before coming out with stories. So, as everybody is aware, the earning season is ongoing in most countries. So is the case in US. So, as of last week, 62% of S&P 500 companies had come up with their earnings. And I just want to share the EPS growth number that has been declared till now. And all of you will be quite surprised. In fact, the whole industry is surprised. The EPS growth, year on year earnings growth by S&P 500 companies is 16.2%. Okay, I just want to let that sink in. The largest economy in the world, where we are seeing that valuations are expensive, just forget everything aside and keep everything apart and just think about earnings growth. US is having an earnings growth of 16% annualized return. Okay, this is the pace that they're doing, and this is when there is a lot of noise about Trump tariffs, about reflation coming, recovering, which we call a reflationary environment, as well as a concern on valuations, right? But despite that, you look at how fundamental corporate earnings are growing, and US is the fastest earnings growing market in the world right now. Okay, and I want people to notice that, because a lot of times people think that it's actually India and China are actually leading that. But if you look at current growth, US is the one that is leading corporate earnings growth. Okay, so that's where we are on US. Are valuations at a stretch in US? Yes, valuations are expensive in the US, but not in the overall market, primarily in the large tech names, what we also fondly called Magnificent Seven. That is Amazon, Apple, Microsoft, Nvidia, Tesla, Meta, and there's one more that I'm forgetting. So the Magnificent Seven stocks have been trading quite expensive for the past couple of years. They have been the driver of returns in the US equity for the past couple of years. But if you look at, other than those seven stocks, the remaining 493 stocks, valuations are very good. Earnings growth is quite strong. You have minimal impact from Trump tariff policies. So a domestic bank like a Wells Fargo, for example, has relatively, completely insulated itself from the tariff war that Trump is undertaking. Okay. And you have good corporate governance. So I'm talking about large cap, big names, the bluest of blue chip names of the world, and they're doing quite well. Right. So other than the large tech names, I would say that US doesn't even have a valuation problem. The large tech names obviously have a valuation problem. There is no denial in that. But fundamentally, they are still very, very strong. Okay. There was a news from China coming in about the DeepSeek R1 model. The correction in NVIDIA stock was barely 10% in the month of January. And let me tell you that NVIDIA has run up by almost 160% in the past 1.5, 2 years. So after 160%, a 10% correction is basically nothing. Okay. And why is that? There was a lot of news, there was a lot of panic in the market or supposed panic. But why was there only a 10% correction? Because the earnings are still there. Okay. And again, I want to bring the focus of investors back into the thing that, a lot of times investors compare it to a dot-com bubble of 2000 that happened in the US, right? The thing that was happening then was investors were throwing money at companies in the hope of making earnings, right? There were no actual earnings. Okay. And that is, there was a very significant crash at that point of time in the internet names. This is not the same time. These companies are cash rich. They are generating revenues by billions of dollars. They are doing capex in terms of billions of dollars, and their EPS is growing anywhere between 25 to 30% year on year. Okay, so that's about the US. Let's talk about Europe as a continent. Uh, Europe has struggled as a continent in the past 2.5 years, primarily because they have struggled with their energy needs from Russia after Russia waged war on Ukraine. So they have been sanctioned, and Europe is heavily dependent on Russia. What is happening now in Europe is three, four good things are happening. First is that inflation is at a very controlled level in Europe. Hence, you are seeing central bank in Europe, that is the ECB, cutting rates. They just cut rates 2 weeks back, and they will be cutting rates even more going forward to stimulate growth. And that is a big support for equities. Second, valuations are very, very reasonable in Europe. Okay, Europe is not a tech heavy market like the US. Uh, Europe is a very fundamental old world economy kind of a market where you have industrials, consumers, and financials dominating the index. All of them trading very, very reasonable valuations. And a lot of times investors just pick and choose names for valuations, right? Third, economically, they have seen the worst is behind them. Okay, we are now seeing Trump calling both Putin and Ukraine president and trying to get an end to the war. The moment this war ends, it's a major victory for Europe in terms of economic support. It will be a major tailwind for Europe as European equity as an asset class, right? And fourth, the barrier or the benchmark for growth in Europe is very, very low. So it's about expectations. So for example, if you talk about US tech or you talk about general US equity, you are expecting a 13, 14, or even a 12% kind of an earnings growth. They're delivering 16, but the expectation is 12. In Europe, the expectation is 6. Okay. So by beating a lower benchmark, so even if you do an 8% growth or a 9% growth, your stock appreciation will be very, very significant. Okay. Europe's economy, like I said, has seen its worst. They have held past that, and they are now on the path of recovery. I'm sorry, was there a question?
No, I think Pratik, you can continue.
Okay, okay. Third economy that I want to talk is Japan. Very separate economy, geographically as well as demographically. Developed worlds are seeing interest rate cuts or expected interest rate cuts, be it the Fed in the US, be it ECB, be it Canada, be it Europe, right? Everybody is talking about cutting rates. Japan is the only developed country that is hiking rates, right? And there, I'm sure all of us have heard about 3 decades of Japanification. There was basically no growth and no inflation in Japan. So today, if we look at Japanese economy, there is wage growth of 5%, Okay. And just to add some context, there was 30 years of zero wage growth. So that's basically an entire generation working, retiring at the same salary pretty much at where they started. Okay. There is no wage inflation year on year. Now the wage inflation is 5.3%. Japan had no inflation as a country for 2 decades. Now their inflation is almost 3%. Okay. And you have consumer spending increasing. Okay, so now they are starting to behave like other developed economies, and that is why you are seeing the Bank of Japan raising interest rates. It is at a 17-year high, and it is still at 0.5% only. Okay, so the rate is not very high, but they have brought the economy back from negative interest rates. Now it is at 0.5%, and this shows that the economy is robust enough to handle high interest rates. Okay, you will be surprised to know that an investor of the caliber of Mr. Warren Buffett has taken exposure to 5 Japanese trading companies. Okay, and he together holds 8% allocation in those companies on his books. Okay, so Japan is slowly picking up in the global markets. And the last I will talk about is China. China has been in the doldrums for the past 5 years. Ever since COVID has hit, they have never seen a recovery like what has happened in India or any other developed country. Now you're starting to see with the DeepSeek R1 model, Chinese tech names starting to rally. Okay. And just to give you some context, China is a black box and will always remain a black box. So you always have to take their numbers and their news with a pinch of salt. But I'm not talking about state-owned banks, or I'm not talking about their banking, their government-owned sector. I'm talking about their private technology names like Alibaba, Tencent, and Baidu. Okay, these are from three of the largest names in China. All of them, in some form or the other, will benefit from their own homegrown technology on AI. And if you see Alibaba's stock, it has gone up very significantly. Part of the reason is that all of these companies were doing a very decent earnings of 10 to 11% across all these 4 or 5 years, but the price was moving nowhere. Okay, so just to add some context about how cheap China market is, India and US both are trading at or close to a level of 20 PE. Forward looking is 20 to 21. India has corrected slightly, so obviously you will have it lower. China is trading at a PE of 9.8 PE. That means that the valuation is exactly half of what you're seeing in other global markets, right? And therein lies that opportunity that whenever you think about, you know, pulling money out of US. So I want to tell you how global money managers think. Okay, I have worked with a few of them. I've had the good fortune of thinking about them, working with them, and how they think is, so let's say I am a pension fund. I have $100 billion, and I have a mandate to invest 70% of it, say, in equities. So I have $70 billion that I want to invest in global equities. Now, today I will think, where is my best opportunity? Is my best opportunity in US tech? No, that rally is already run up. So I will pull out my profits. Now I will see in global markets, where else can I go? I'll go and say, okay, China is looking slightly cheaper. Let me take a small allocation to China and see how things are going there. I'll think about Europe. Again, very reasonable valuations. Rate cuts are happening, so tailwind for equities. Russia war might end, positive for Europe. I will invest a little bit of money in Europe. I will go to some sector in Japan. I will invest in US, but in US, I will be underweight on technology, and I will be good overweight on consumer sectors. Okay, consumer spending is very strong in the US, banking is very strong in the US, so I will invest in these names. Okay, similarly, in the same breath, if I talk about India, the reason that FII flows are happening, outflows are happening in India is because these players have made massive money in the past 5 years. India never saw any correction from 2020 onwards. Okay, 24 out of these 5 years, 2020, 2021, 2023, 2024, you had 20 plus year returns. Not 2024, 2024 was 10%, but 3 out of these years you had 20% plus returns by the broader market, Nifty 50. Okay, stocks were doubling year on year. So, any which ways, there was a lot of money chasing these markets. We were growing well. The earnings growth was strong. Now, earnings have slowed. Currency is depreciating. So, FII money is going out. and they have realized that there are better opportunities as compared to India. So we will go in those countries.
All right, thanks, Prateek. That was a very detailed but yet very neat explanation of how to think about the global markets. Think the next thing, I mean, on in the broader context, we also want to talk about what do you think about the dollar's relative strength with respect to other currencies and especially INR because that is of relevance to most of us. So if you could, shed some, light on that, what are your views?
Sure. Sure. Can we move on to that currency depreciation slide also, please?
Yeah, sure.
Yeah, thanks. So let's just talk about numbers again. Key, how has history seen numbers, depreciating? So I'm going 10 years back, but I can also go back another 20 years. I remember 99, 2000 rupee was trading somewhere between 35 to 40 per dollar. But let's just look at since 2014. We were somewhere close to 60 per dollar, right? And you look at an annualized return, the rupee has depreciated on an average 3% per annum versus the US dollar. Okay, it has been a trend for the past 20 years. Okay, even this chart is slightly dated. This chart currently shows 86. Rupee had touched 87.95 before the RBI intervened and held it back a little bit. Okay, the view in the market from large brokerages is close to 100. Okay, what was happening in India was the last RBI governor, Mr. Shaktikant Das, he had no issues domestically other than inflation. So they were keeping rates high, but growth was going along well. So they were slightly in support of rupee. They were supporting INR versus the dollar depreciation. The new RBI governor, Mr. Sanjay Malhotra, clearly said that we don't have the bandwidth at this time to support the rupee and we will slightly let it fall. And you will see a very sharp decline. Let me just give you some numbers. 2024 January, so just 13 months earlier, rupee was at 83. Okay. It ended the year at 80. It was still 83, 84 by the time Trump election happened. And after that, from 84, we are already at 87, 88. So over in the span of 2 months, you have seen the rupee depreciating by more than 4 rupees. Okay. This has been an anomaly that, there has been a very sharp depreciation, but there is nothing to suggest that the structural trend will stay. And in the next 2 years, 2 to 3 years, so nobody can exactly time it, but in the next 2 to 3 years, I will say you will see rupee comfortably at a range between 95, 96 to 9800.
Got it. And Prateek, if you can also like help us understand like what are some of the factors driving this depreciation of the rupee. One obviously could be the inflow and outflow of money by large investors. Other could be some macro factors. So if you could just shed some light on that.
See, the primary difference is always the real differential between the real interest rates in these two economies. Okay, that is the most fundamental economic explanation as to why any currency depreciates. Okay, interest rates and inflation. So if US has an inflation of 2% and they've always structurally had an inflation of 1 to 2%, okay, again, in even the current times, it will still back down. It might take a bit of time, right? And in India's inflation is always at a 5 to 6%. Okay, we are still struggling to get it down to 4%, 4 to 5% rahega, right? Which means that you always have an interest rate differential of 2.5, 3%. Okay, now that interest differential is what economically the equation suggests that should be the annual rate of depreciation of one currency versus the other. Okay, that's a very theoretical explanation. That's what I'm trying to tell you. So theory made that's what happens. In reality, there are multiple other factors also. This remains the base, but obviously FII flows and your import and your deficits play a very significant. So
Got it.
primarily India's continuing import of oil, gold, and India's dependency on FIIs. So India is still it's only a 2%, 2.5% market capping. You look like global equities. So India is still a pretty nascent market in terms of a large player like a US or a Europe. Okay, I'm not talking about GDP growth. I'm talking about what is the allocation of India's market cap in a global currency. Okay, so 2.5% is what where share is, and past 2 years, there were a lot of news that SIPs are supporting domestic markets, and that was correct. That was correct to some extent, but we have seen in the last 3 months that FIA flows can also drive a lot of money out, right? And Indian markets were again trading expensive, so they needed a reason to correct, and this has been the reason. So FIA flows, our deficits, and our interest rate differential with large economies drives the currency movement.
Got it. So, no, thanks a lot for that explanation, Pratik. So, I'll just summarize the discussion so far before we move on to to talking about what should an ideal allocation strategy for NRIs look like. So, geographically, if we look at US, that has been a bright spot in terms of earnings growth, as Pratik said, like 16% year on year. And remember, this is in dollar terms. So that's definitely fantastic. India, with respect to India, I mean, the valuation is pretty much similar. But on the India side, the growth could be slowing, the currency is depreciating. So these two are the dampening factors. Other than India and US, we have Europe, which could see a major upside trigger, especially with the war ending. And then China, because of the last 5 years of not so much growth after COVID, is trading much cheaper than the global peers. And Japan is also on the path of recovery. So this is how the entire globe is structured today. On the currency side, this trend of around 3.5% depreciation is expected to continue for the next few years at least. And that brings us to the next question that is on everyone's mind. So, considering all of this, how do we put together, an ideal portfolio, for a global Indian in 2025? But I'll just take, I think there are a couple of questions in the chat. So I'll take one right
Uh,
now, and the
yeah.
other could be taken after this. Is this is sector specific question? So Prateek, just see how much you want to get into this here. So Pashwa is asking, could you also cover how you see securities in the energy and sustainability sector? How are they going to be impacted by US policies? And also, if the Ukraine conflict ends, is energy sector a good sector for investment in the next 2-3 years?
Uh, The short answer will be no. Energy sector will not be a good sector to invest in the next 2 to 3 years. I myself held allocation in global energy sector till the last year. Okay, but as of today, the scenario is that there is a surplus of oil, not just by US, but also if you see the OPEC plus, their production is below at their maximum capacity. Okay. And the reason is that because if they flood the market with oversupply, the prices are going to go down even further. Okay. So I'll split this answer quickly. Traditional energy and sustainable energy. Traditional energy, the answer is no. At this point of time, there is enough supply and there is not enough demand. Okay. With Russia, if the war ends, you will have sanctions removed from Russia. So they will be able to also ship their supply of oil and gas into the world, which means again that there will be enough supply. The exact opposite thing happened in 2022 when the war was waged, that there was suddenly a shortage of both oil and gas. Okay. And there was a time in 2022 when oil shot up to $120 per barrel. Okay. So this is a political game that when it happens, when a political impact, that's how things move. So no energy, don't think traditional energy will do well in the next 2 to 3 years, with Trump again saying Trump's focus is more on the energy. Let's just drill. Okay. So you expect US energy production to go up. Okay. And once US energy takes up, they will make sure that, the international oil prices do not shoot up, because that causes inflation across the globe. Renewables, well, see, renewables has been a theme running primarily from Europe. Green energy or clean energy was a story that more it's coming from Europe. European investors are more focused on that rather than a US. US is more capitalistic. Okay, so they don't really care about renewables or whatever. Renewables have unfortunately taken a backseat because you have more painful issues and more structural issues at hand. Okay, so renewables, what will be the impact on them? I think it is hard to say, to be honest. But at the same time, I will say that I don't have great hopes in the next 1 to 2 years about renewables picking up massively. Again, Trump has pulled back from the Paris Climate Treaty Agreement. So US is very clearly positioned for the next 4 years that we don't want to be a part of these renewables and all. We are a capitalist economy. We'll behave like that. So there is very limited support in support of these themes.
Got it. Thanks, Pratik. And just to add a little bit of disclaimer here, given the questions also that are coming in, like we have requested Pratik to be as frank about his opinions, but at the same time, the standard disclaimers apply that it is not supposed to be interpreted as investment advice. This is a closed door meeting. Hence, we have requested him to be candid. But yeah, please do make note of that. And with that in mind, let's take up the question that is coming in chat as well as an overall thing that, okay, now given all this information, how should, global Indians, NRIs structure their portfolio?
Yeah. I think that's the most important question of the day. So I'll start with an assumption here, and I think Ankur and Kunal and I had this discussion that we are assuming that most of the audience here is an NRI audience who have come out of India, working from their job. So all the audience and all the people listening to us here will have some level of wealth in India as well, right? Whenever they would have started working, they would have some investments in INR in Indian markets. My response to this kind of a question is, if you do not see any need in the immediate future, and by immediate I'll say next 2 years, for you as an individual to go back to India and and move your base, then I think there is absolutely no reason for an NRI investor to invest in Indian market at this point of time. Okay, the rupee is depreciating. There is a lot of correction in the market. This year is going to be especially volatile for Indian equities. I think that much is a given. Okay, if you look at all the large fund managers or the biggest fund managers in India, people like Prashant Jain, people like Sunil Singhania, people like Nilesha, these are heads of Kotak, heads of Abacus, and head of 3P. They have all said that in Indian equities, you need to temper your expectations that 20-25% return is not going to come back in the near future. Okay, so investors have made a lot of money, but the immediate future is going to be a little more volatile, and obviously there is a correction coming in. Okay, so there is no immediate reason that I see that you move your dollars from your base country to India and invest in that, assuming, like I said, that you already have a decent chunk in India. Okay, if you want, yes, you can take a tactical bet. There is a question that can you take mid and small caps allocation recently? I would say no. I think the pain is not over. Okay, so just wait and hold for it a little while longer, because the market just keeps opening on a red every Monday morning because something or the other happens on the global level, which means that you have to invest globally, right? Because there is not enough developed financial market in all of the UAE or in the Middle East region. So if you speak to anybody based in Dubai, Middle East, Singapore, Hong Kong, all of them talk about global investing. So at this point of time, you have to start thinking about investing your dollar money into dollar assets and earn, say, a 13, 14, 15% kind of a return, right? Because any day, let me tell you, in global markets, a return of 13, 14% without any leverage is considered very, very good. Okay. And on top of that, if you really want to move your money back to India someday, this 13, 14% annualized return means you add 3 to 4% of currency depreciation. So you're anyway sitting at a 17 to 18% return in INR terms. Okay, so it is still very, very significant. If you were to say, if you have to have a case for investing back to India, your threshold should be that with currency depreciation, if I am making 15, 16, even let's say conservative, I'm making 15, 16% in a fund in global markets, can I make more money than this in Indian equities through a fund? If the answer is yes, only then you should think about Indian equities. Okay. Best case scenario, you have seen global equities delivering 20% plus returns in a single calendar year in USD terms. Okay, so once you are seeing 20% equity returns in calendar year, which means that 23, 24% returns are in INR currency, right? So the case has to be very strong for you to send your money back to India, because one, Indian equity is going to be volatile for a period of time. Don't think that the bottom has come yet. I think we still have to see a lot of things, because Modi's visit to Trump has not really yielded a lot of things. We are still awaiting tariffs from Donald Trump. Okay, valuations are stretched in India. Earnings growth is slowing down, and now we will be dependent again a lot on monsoons. Okay, it's already quite hot in India. I'm based out of Bangalore. I'm seeing the weather is pretty hot at this point. So monsoons will drive Indian economic recovery, especially the rural recovery, and that is not a bet that you want to take, with a significant chunk of your wealth. Let it play out. Then you should invest in Indian equities. But again, the benchmark threshold should be that if I can make 14% dollar return, which means 18% rupee returns in global markets, my threshold has to be higher. My returns have to be higher in Indian market for me to consider that.
Got it, Prateek.
And sorry, I
Yeah.
so we've talked about global markets. We can also talk about, Ankur, within global markets where to invest.
Yeah. I think let's come to that. But
Yeah,
again, just like summarizing the whole thing, and especially see from a retail investor, from a regular investor perspective, right? It's very difficult for us to time the markets or rotate money across geographies. So Pratik, what I want to also understand from you, and most of us on this call would fall in that category of investors, that okay, if we want like a stable core portfolio which is well diversified, where we don't
right.
have to constantly keep looking at the markets in order to decide where to invest, like what
Yeah,
what can that look like, where we can get the most out of it by getting 80-90% of the effect by doing 10-20% of the work, right? So that we are not
correct.
actively managing our money, right? So you can blend that into the question that you also said, that where in global markets. So what
Yeah.
does like a core portfolio look like?
Yeah. If you can move to the slide about the portfolio allocation. Yeah. So let me just break down about key level. I was talking about how to build a global portfolio, right? Let me just start by saying that a multi-asset approach is actually the best approach. Okay. So you need to have, no matter how young or how risky you are in terms of your investor appetite, you should always have 10% or 15% allocation minimum to safe instruments. Okay, so that means that 80-85% allocation should be your highest in equity. You should not go more than that, because I have seen people putting 100% in equities, and if that corrects 30%, the loss is very, very significant. Okay, so the ideal combination is more like a 70-30, 70% being in a global equity portfolio and 30% being in global fixed income or commodities. Okay, what this does is both commodities and fixed income provide a very diversified exposure as compared to global equities, and that is what protects your portfolio in bad times. Okay, the thing with constructing, like you mentioned, Ankur, if you have to construct, the way I like to speak is I use the word then all weather portfolio.
Yeah.
With most people being busy in their day jobs and nobody has the time to look at markets on a daily, forget daily, even monthly basis, sometimes people don't have the time to look at their asset allocation. I can very confidently say, you construct a 70-30 portfolio, you can buy and forget for 5 to 10 years at an asset class level. Okay, don't be too greedy and say 80-85, let's increase beyond that. Plus minus 10% is completely okay, and that is what we also do. But let's not get greedy, or let's not get overly conservative. Now let's talk about what comes within these equities. Okay, so I will primarily break down equity into 4 parts. One is obviously US equity. Second is developed ex-US equity. So developed ex-US consists of primarily Europe, Japan, Canada, and Australia. So Australia will be again a very small part, but if you look at by weights, Europe, Japan, and Canada are the 3 major countries that come as a part of this. Then you have emerging markets led by China, India, and Brazil. And then the fourth is thematic, that we like to play, that you need to have certain themes playing out. And that is where you want to play those themes. For example, current themes being semiconductor, AI, EV. EV as a theme is playing out quite nicely. It has played out quite nicely. It's not just about Tesla or BYD. It's also, there's a lot of auto ancillaries that have grown a lot with these kind of names. So certain themes are always playing out in the market. So if you look at the first three, you primarily cover the entire global, entire geography. So you're covering US, you're covering other developed markets, and then you're covering emerging markets. So what happens with this is you have some allocation to Japan, Europe, countries like Korea, Taiwan. Korea is dominated by one single company, that is Samsung. We have all used or heard Samsung in some form or capacity, but Samsung is not listed outside of Korea. There is a Taiwan company that manufactures chips for Nvidia, and the name of the company is TSMC, Taiwan Semiconductor Manufacturing Company, only listed in Taipei Stock Exchange, not listed anywhere else, right? That is what you get. You get a diversified exposure, and you get exposure to the best technologies that are available throughout the world with the first three line items. And then the fourth line item is basically what themes you think are playing out is what you play out, be it financials, be it technology, be it consumers. So currently I'm underweight. I'll give you my honest positioning. I'm underweight on US technology. I'm overweight on financials, and I am overweight on consumer spending. Okay, staples, not discretionary at this point of time. So these themes, then you look at, okay, this is my view. How do I express this view in terms of choosing a product? And then you go ahead and invest in that kind of things. Fixed income, I largely split it into treasury ETFs. That's basically US government bonds, and then some fixed income funds. My objective of fixed income is never to generate returns. I am okay with a subpar return for fixed income. Fixed income is done primarily for an safety purpose, for providing that cushion to your portfolio that you take with equity. Okay, so there is a risk in your portfolio. You want to balance that risk, you take a fixed income. And then there is commodities. They've listed the commodity instruments, but commodities is primarily oil and gold and silver. Okay, so you choose whatever is doing well at this point of time. So for me, oil is not doing well. Gold has done fantastically well in the last 1 year, and it is still continuing to do well. And same is the case with silver. So at this point of time, I have allocation to both gold and silver, 2.5% to each of these products. Right? Kunal, if you have the portfolio, can you also put that up? Yeah. So this is the actual product. So this is a portfolio that actually I manage publicly. And like I said, all the line items are stating to the asset classes that I covered. So the first line item is basically US equity. Second line item is developed ex-US. Third is an emerging market mutual fund. The first two are ETFs. Third is a mutual fund that takes bets in India, China, Brazil, and other emerging markets. Then the fourth and fifth are basically you are seeing thematic biases, financials, and technology. I have a couple of single stocks that I feel that are doing quite well. NVIDIA I've recently added because it has corrected quite decently, and I'm okay to hold it for a decent period of time. Then there is fixed income. Like I said, treasury bonds, that is the safest instrument on earth. Then you have another fixed income fund, and then I have gold and silver. Trust me, you put this kind of allocation for 10 years, let's say 5 years. 10 is a bit too much because markets are much more evolving now. But with a 5 year, this kind of an allocation will give you a return between 13 to 14% quite comfortably, because there are enough drivers for you to pick up. If equity does poorly, you will see gold doing well, you will see fixed income doing well. If equity is doing well, nothing like it, you are quite well diversified. If China picks up, the emerging market thing will do well. If US does well, you have the technology and the first line item doing well. If Europe does well or Japan does well, the second line item will do well. So the beauty of global markets is there are so many things that can drive your returns. And like I said, with the starting of my answer, that global allocators think their money in terms of each other. So it is never purely US. You'll always compare US equity with European equity, with Japan equity, with China equity, with India equity. So somewhere the money will go, right? It's a very rare scenario that they will all pull back from all their equity. That never happens unless there is a catastrophic event happening, right? You will always put your money in equities. And my sense is that if you invest a decent chunk in all of these portfolios, in all of these geographies, it's not very difficult to make a 14, 13, 14, 15% dollar returns CAGR. That's annualized return over a 5 year period.
Got it, Prateek. So Prateek, let me put you on spot here, maybe a bit. Uh, Managing, let's say, even a 10 fund portfolio or 10 ETF portfolio is going to be difficult for regular investors like us. So
Yes.
if you are to strip it down to say five funds, right? What would you pick? Or let's say four funds. Because two are stocks, so let's take out single stocks. So let's say four funds.
Let's just make it very simple. I can strip it down even further. The first three products, that's primarily equity, right? That covers your entire geography. Geographically, you're well covered, and maybe then just go for the US Treasury. That's it. If you have to give you four products, that's it. We the investor will still need to decide the position sizing and what how much asset
Sure.
allocation to make. But if you want to just take products, four products are more than enough.
Awesome. Got it. Uh, yeah, we can pause here to take some of the questions. I think the questions on chat have already been answered. Or yeah, we can move on to the next part where Pratik, we can discuss, some of the do's and don'ts of investing that you have seen, amongst your clients. What are the mistakes some people make? What are some of the good practices? Some practical tips.
Yeah, yeah. Can we move to the slide? Yeah. So I think the most significant thing that an NRI investor has to do when they look at global investing is you need to find a core and balanced portfolio. Okay. Uh, don't base your entire dollar wealth on a few risky bets. Okay. India, a lot of you obviously have decent portfolios or even fairly large portfolios in India. And I'm sure they're all quite well diversified, invested in 2 to 3 funds, single stocks. So that exposure is quite diversified, right? The my only request is that people should not buy that just buy the hot trend and put all your money there and then see it volatile and churning your stomach, going down up and down 5 to 10% every single day. Please don't do that. Okay, I understand that it's a new market and it's a very huge market as compared to India, so obviously it's going to take time, right? But like I said, you should not be in a hurry to just deploy your money in chasing returns and taking risky concentrated bets. You have to focus on global diversification. The biggest allocation will obviously still remain the US, because US is the world's largest democracy, largest economy. You can't ignore that, but you have to focus on global diversification as well, right? Avoid picking single products just based on their returns. Think from your overall portfolio allocation perspective. Like I showed, 70% has to be equity. Again, within equity, there has to be US, developed ex-US, and then emerging markets. So think about your portfolio allocation in terms of percentage terms. Okay, I will really request all the investors sitting here that start thinking about your investments not in absolute money terms, but in percentage terms. So if you have $100,000, you should not be putting more than 80,000 in equity at any point of time. Okay, so that's 80%. That's where I'm capping it at. Okay. Special focus on position sizing. So that's where the skill of a portfolio manager or an active manager actually comes into play. So I want to give two examples how position sizing plays a role. This is two very personal examples of clients that I've handled. So in 2022, I was handling a client based out of Dubai. He was a director in HUL, in Unilever, not HUL, and he had invested a majority of his wealth in high risk, all the basically the big tech names, the Meta and the Nvidia and ARK ETS, all high risk names, right? And he had taken massive positions in them. In 2022 was a very bad year. All these allocations were down 50 to 70%. And he really repented those decisions. He wanted to take exposure to these asset classes. That's completely okay, right? But what he made a mistake was he took too much allocation to these. They were not diversified enough. Okay. Like I'm saying, global markets are too large to focus on just stock selections. Okay. In India, we can afford to look at top 50, 100 names and choose among those names. Global markets are just too large. Nobody can cover single stock. So you have to focus on products. You have to choose whether an ETF is good or a mutual fund is needed to play the US technology themes. You can play single tech names as well. That's completely fine. But that should be a tactical part of your portfolio, not the core part of your portfolio. And core also, it should be a part of your portfolio only when your full-time job is basically to track these markets. Okay, if your job is not to track what is happening, see, the Trump administration is very, very dynamic. They come up with new news, new rules every other week. Okay, if you feel that you can track that, by all means go and take good bets in single stocks. But if you really think that you don't have the time, then please don't do it as a major portfolio, a major allocation of your portfolio, right? And again, the last point is that you need to identify the themes that are playing out and take exposure in that. Like I said, AI, semiconductors, Europe recovery, China might be one story that might be playing out. So that's the advantage of having professional fund managers who identify the themes before they start to play out. Now, today, everybody knows that AI and semiconductors are very big themes and they have run up quite significantly. But financials and Europe recovery, and to some extent, even China recovery is not yet captured. Okay, they might play out, they might not play out, but anybody who's doing it for the full time, we can only be the best judge of it, right? With China, then again comes a don't, that don't buy high risk products when you don't understand the underlying investments. Okay, China is a very, very volatile market, extremely black box, like you don't know what rules will come from there today and what might change tomorrow. So you don't buy high risk products without consulting your advisors. Okay, be wary of investing in expensive funds. So let me tell you again a personal example. I have managed people who sit out of Singapore, Hong Kong, and Dubai and Riyadh, and they all have access to banks and bankers. And most bankers tend to do product pushes with, they will give you a mutual fund which will have an expense of 1.5%, and a high commission out of it goes to the banker himself, right? In global markets, the beauty of global markets is that you don't need expensive actively managed mutual funds. The great Warren Buffett himself has said that, I'm sure you would have read the story about how passives are doing well over active. So passives is nothing but ETF. So any exposure to a US or a Europe, you don't need a mutual fund that is charging 1.5%. You can just play that story by ETFs, right? ETFs are what charging 4 bips, 5 bips, right? 100 bips is 1%. So 0.04% is the management fee, right? The advice you need is when to go in which theme. But there are multiple instruments that if you simply just Google or you put into an AI chatbot that what are the best products, best ETFs to invest in US equity, you will get very quickly a list of 15 to 20 names, right? Ignore the more expensive products because they eat out 1.5-2% of your alpha. Look at ETFs in developed markets. All right. So you don't need expensive products in developed markets. And lastly, I would really urge all of you, please do not think about taking leverage. Leverage is a double-edged sword. People think that, I can invest 100,000 and take leverage of 900,000. And banks tend to push these kinds of deals, by the way. So you will have $1 million and then you can make 5x on it. Don't fall into that trap. I'm assuming that, any smart, stable investor, unless you have, a lot of money, so unless you have $100 million, which you can afford to lose, say even 10, $20 million of that is fine. But if you're not that kind of an investor, don't fall into the mentality of let's get rich quick. There are, again, like in India, there are no get rich quick schemes. Focus on building a stable portfolio. In 5 years, you can double your money in dollar terms with a 15% XIRR, which means that in rupee terms, it will be almost 2.5 times in 5 years' time. Okay. So think from a long-term perspective. Do not think that let's get rich quick by taking leverage, because leverage cuts in both ways. You not just get margin calls, so you have to fill up your cash again into the account, but your underlying value also falls very drastically. And it has not been a very long time. It was 2022 when this was happening, and I was in the market then, so I've seen the kind of pain that investors have gone through. So please don't indulge in that.
Yeah, thanks, Prateek, for that. And personally, the three pieces of advice that really, resonate with me are: A, diversify across asset classes as well as geographically. Do not invest in what you don't understand. And the third thing is what Pratik just said: do not take leverage. like that can really really impact your personal investments, personal financial health in a major way. So thanks Prateek for that. I'll just wait for any questions since we're done
Yeah,
with.
I
Yeah,
have a question. Hi,
yeah, hi,
Prateek,
Rakshit.
Rakshaka this side.
Hi,
So
Archana.
while I do understand that China is a tactical call, but what makes you think? While okay, the PE is lower than US and India, I understand that. But we were expecting a lot in the past few months. जब stimulus की announcement हुई थी, we were expecting a lot much from China. Based on trigger, उनकी market भी काफी positive गई थी. But then recently their PMI data came out and it was below 50, and the economists there are now saying that the stimulus was not enough and they don't know how to pick up the economy. Plus अब ट्रम्प की पॉलिसीज भी बहुत अनप्रिडिक्टेबल हैं, स्पेशली फॉर चाइना. सो
Yeah.
what are we betting on apart from the lower P? Even if we are taking a tactical call on China, what is it that we're betting on?
Yeah,
Yeah, great
thanks,
question.
Rakshika, for your question. If you could also just quickly introduce yourself, where you are joining from, for others, that would be very helpful.
Sure. Hi. So I work in ICICI Prudential and I handle family office and NRI investments here. And I'm a product specialist. So yeah, I'm joining from India itself, but my customer base is completely different.
Thanks, Rakshika. Yeah, Prateek, over to you.
Lakshika, great points. And like you said, the domestic issues of China market have not been resolved yet. I am not making a case that, Chinese domestic demand is back. That is not the case. Okay. What is my biggest, I'll tell you my biggest signal when we talk about Chinese equity or, recovery in markets. Okay. So first of all, we need to understand that recovery in markets is quite different from recovery, in the underlying economy, right? That might be delayed. But what is happening is FII money is now starting to go back to Chinese equity. Okay. With the deep seek disruption, uh, I don't know how many of you are aware of this. China actually, this is my theory, but the theory is that China actually planted the deep seek news very, very tactically, because Monday this news came that there is this model called DeepSeek, and Tuesday onwards China went on holiday for the Chinese New Year, so the market was closed for the next 5 days, 5 business days, and guess what happened? The whole reverberations or the whole correction happened in the US markets. Okay, what I'm trying to say is that a lot of global investors now starting to put their bets on the fact that sooner or later Chinese government will start giving out more stimulus. They already started with some stimulus in September of last year, and there was a 25% recovery in Chinese equity in just one single week. Okay, I just want to drive that point. And this is a broader market. 25% markets were up in just one single week. And again, they fell down because the economic stimulus was not as great as the market had anticipated. And there is a reason that the stimulus was not as big, because China was preparing for Trump to come and to see his policies. And that is when they will release further policies and further funds. Okay. So on on the government side, I think we are seeing a change in the stance of the government. Earlier, for the past 2 years, they were in denial mode that the economy needs support. There was no support from the government. Now that is starting to roll in. Okay. That will take time to have an impact economically. But on that change in stance, if foreign investors, and again I'll say if foreign investors start putting their money in the Chinese equity market, that means that the government will do more of it, and then it becomes a chicken egg situation, that the foreign money is coming in, so now the government has to do more to bolster the demand. They will give more stimulus, and then which will lead to further money into the foreign flows into Chinese equity. So I am not, I'll say I'm not completely positive on China equity. I'd say I am a 5 on 10 on China equity. I still have very small allocation to China equity, because I know when it will start growing, it has a massive room for expansion. It has a massive room to run. So it is best to keep some allocation in China, but it has to be very small, and then you have to play that smartly.
Thank you so much. That makes sense. But also, you said don't be too bullish on Indian markets right now. While I do understand there's a earning problem and currency depreciation, but our rural growth is strong. Like in India, if we see some sectors are still performing well, and you just mentioned semiconductor ka space. So there's a company called KIAY, Keynes Company, which is in the semiconductor space, and their results were also positive despite their price correction happening because of sentiments. But India, maybe there are some sectors which we feel, so with RBI actively intervening and monetary policy plus fiscal policies, we also see in India that banking and financial services would be a good sector to come in, and it is undervalued also at this point. So don't you feel someone can have a little bit of exposure in India, at least in banking and financial sector?
No, I actually never made a case against India. Somebody asked a question on mid and small caps, and I said that I
Yeah, yeah.
think further correction is still warranted. It might be still might there still might be more pain. Okay, Indian economy, yes, I think fundamentally remains quite strong. Okay, but the whole discussion is from an NRI perspective. Yes, Indian markets remain strong. There are pockets of value in Indian equities as well. There's no denial in that.
Yeah, I think you were talking in terms of dollar. Dollar के terms में या convert करके आएंगे, that could be a problem. Yes.
Yeah.
But thank you so much. Thank you. Helps.
Thanks, Pradeep. Yeah, guys, feel free to ask your questions.
Yeah, hi, Anku.
Yeah, hi, Anil. Please go ahead. Just a
Okay,
quick intro, and then please go ahead with your question.
yeah, I'm located in UAE, in Dubai, and I've been part of a software company here. However, okay, this is off topic in any case because we were discussing the asset allocation with respect to the fixed assets as well as the stock and ETF. So I see Pratik is more of ETF person, so that resonates as well. The US markets and other stuff. So, uh, since we are hoping Beyond Belong will show soon start its operation by this month. So when can we expect the operations and what are being planned? So this is explicitly for you, not Pratik,
Yeah.
but in any case, if you can take it later, it's fine. But just wanted to hear from you on this.
Yeah. No, thanks, Anil. Yeah, we happy to answer that. So, yeah, I think Kunal, if we can move ahead. So happy to tell you guys about what we have been up to at Belong. Some of you already know, but for those who are joining us for the first time, so it's a savings and investment startup for NRIs. We are using the regulatory platform of Gift City to provide these products, which is specifically beneficial for NRIs in multiple ways. Uh, like easier KYC norms. You have the option to invest directly from your foreign bank account. So, for example, if you're in UAE, you can invest directly from your UAE bank account. You don't need to go via NRE and NRO bank accounts. There's full repatriability. And for multiple retail products, there is also tax exemptions. Now, Anil, to your question, we are starting with savings product first, so which fits in with what Prateek was alluding to, that even someone on the higher risk profile side should at least have 20 to 30% allocation to fixed income. Within that, it could be bonds, it could be something as simple as a fixed deposit. So that we are expecting to go live next month. There's a slight delay at our end in terms of the bank integration. We're just testing it out. And after that, on the equity side, we are looking to launch some funds for India as well as global markets by summer. So that could be June or July. And the idea is that it should be a one-stop place for NRIs to be able to invest globally. And as I said, not just India, but also global funds. Some of these funds that Prateek has mentioned. In fact, Prateek's own firm runs a global investment AMC out of Gift City. So we will be working with them also closely, as well as other established players. So that is the update that I have, Anil, for you. So a little more wait, but yeah, we will be enabling savings and investments, everything in the next few months.
Thanks
Hi.
for answering us. Yeah.
Yeah, there's a question regarding the product from Parsha. Is it possible to
Yeah,
register on
yeah,
Belong?
Parsh. Yeah, we are right now. We have enabled that OTP verification on WhatsApp only. I think in a couple of weeks, even the SMS integration will roll out. Just took us some time to integrate with a provider in the UAE, so we should be able to do an SMS verification pretty soon.
So just to follow on that, so is it possible to then change the number or for the account on the app, or once I put in a UAE number, then it's like the account is only set up with that?
Yeah, no, we will be able to. I mean, we are accepting only UAE numbers. Right now, we have not allowed Indian numbers. We wanted to keep it specific to UAE, but we are happy to we have made a note of this, Parsh, and I'll reach out to you separately once we have the SMS integration on how to go about your case. We'll figure something out.
Right, thanks. Yeah, just because I'm based over here in UAE, but I still use my Indian number. But thanks.
Yeah, got it. Got it. Uh, Kunal, if you can move ahead. Um, yeah, this is what I was alluding to. So we are starting with a USD fixed deposit. So given the the depreciation in INR that has happened and is expected to continue, I think this is something that a lot of us would find beneficial. For those who have not yet joined the waitlist, we are running a launch offer, an early bird offer of 1% extra returns over the card rates that Indian banks have in Gift City. And if you refer some of your friends, you can even get up to 6.5%. Uh, yeah. Yeah, Kunal, we can move to the next one.
Yeah, which
Uh,
is actually just, sorry, Ankur, to add,
yeah.
6.5% dollar returns in FD technically means almost an 8-9% FD returns in
Yes.
INR. That is fantastic, guys. I mean, no risk-free money. That's great. Yeah.
Yeah, and that's why I wanted to start with a savings product first. It's an easy product to understand given the volatility in the currency. We thought this would be the most relevant product. So yeah, thanks for that, Prateek. So I would encourage everyone to do that. Kunal, could you also join the Belong community link on
Yes.
chat? And if there
Just
is, yeah, I think this is the QR code for the app. So all of you who are new, uh, please download the app and register. You can get updates about these events in the app itself. There's a community that we have. We will be sharing Prateek's contact in that community. So all of you who have further questions for Prateek or want to discuss the products that he is managing, you can ping him one-on-one as well. But yeah, I'll pause here. We have overshot the time a bit, but happy to take any more questions either on Belong or on Prateek's discussion.
Ankur, any plans to extend the app capabilities or services beyond UAE, like for example, Europe?
Yeah. So, Prateek, so this is just for the first, I think 6 months after we launch, because right now the KYC, we are doing a doorstep KYC. It is paperless, but it still requires us to verify that you're actually an NRI of this particular country. So that bit is there, because of which we have limited it to one geography. But I think in another, like after 6 months of launch, we should be able to expand to other geographies as well. Particularly, there is a proposal of completely digital KYC also coming in within Gift City. So we are just waiting for that to expand to other geographies. But Prateek, just curious, like where are you coming from?
Thanks, Ankur. Hi, sorry, I forgot to mention I'm in Ireland actually.
Okay.
And I
Perfect.
think I did send an email with a similar question. I just wanted to understand the timelines.
Yes.
But I have another question for my namesake, if you don't mind.
Yeah, please go ahead.
I think going back to your original point, Prateek, about making investments by transferring money from dollar to INR and investing in India, whereas unfortunately in Ireland, I don't know what is the level of tax knowledge here, but the tax laws here are pretty much archaic. To give you a couple of examples, obviously on ETFs, the tax is as high as 41%. And secondly, there is a concept of deemed disposal as well, where you have to pay taxes after 7 years, even on your notional gains, which makes it really not so lucrative. So, and this third aspect of this is obviously, as you can see, euro and dollar rates converging towards. It's not growing as much as a dollar would be, whereas historically it is somewhere around 3 to 5%. Does the same logic still apply to euro-based denominations as well, or do you think we still need to balance it out?
Yeah, so taxation is a different topic altogether when it comes to primarily European residents like yourselves, right? So I'm aware that Europe taxation laws are pretty tough. And then that changes the equation, because then you have to figure out mathematically how much are you making post-tax. And I'm not the best expert on this, frankly, but if you figure out that, let's say you're getting a 15% CAGR, so how I would recommend is you figure out how much you're earning with $100,000 investment, 15% CAGR, and then what is the level of taxation that you are being subject to in Ireland. And if that is far lower than what you are expecting versus if you're getting something else in a geography that is much easier, right? I think then the other geography makes sense. So even if that is India, then yeah, absolutely you should do that.
Sounds good. Thanks, Prateek.
Yeah. I think I'll also tell you this one reason why this whole story plays out like this. In most developed countries, in large developed countries, for example, say in the US, okay, Europe is an exception because the taxation is pretty tough and very, very large tax cuts, right? But Europe, there is no capital gains. Sorry, in US, there are no capital gains, okay? For example, in Singapore, there are no capital gains. So the thing is that if you invest in these geographies and then you're making a capital gain, you don't have to pay a tax on that. This changes as per your residence. So obviously, you have to take that into consideration before investments.
Yeah.
And this is Anil. Prateek, I have one more question with respect to the AFs in gift cities. So I see there are pretty much high fee there. So I mean, do you operate any AF as such?
Yes, so my firm basically runs an AIF out of Gift City, which is investing into global markets. And exactly the kind of portfolio that I have showcased to all of you, that is the kind of portfolio I run. So the screenshot was from my own actual portfolio. Okay, so that's an AIF that we run.
Kunal, this is just off bit. So Prateek, can you share your deck? Or, I mean, some.
Yeah, we can do that, I think.
Okay, thanks. So, Kunal, can we get Prateek's deck somehow?
Yeah, so Anil, what I'll do is I'll share Prateek's contact details on our Belong community group, and then you can DM him for any further questions as well as any information on the product.
Perfect. Thank you.
Yeah. Anyone else? Any questions? Feel free to ask. All right. I think yeah, we can then wrap it up. Thanks, Prateek, a lot. Thanks everyone for joining. It was a very insightful session. And yeah, as I said, we will be sharing Prateek's details on our community group. So people who have not joined yet, please do join. I think Kunal has shared the Belong community link as well on the chat. If you have the app, you can directly access it from there as well. And thanks everyone for joining in. Thanks, Prateek.
Thanks, Ankur. Pleasure.
Thanks.
Thank you all.